All right, so we're back and ready to dive into another video.
Always exciting to see what we're going to uncover.
Yeah, so this time it's all about monthly dividend ETFs to earn some income in 2024.
Sounds promising. Lots of people looking for those steady payouts.
Exactly, and who doesn't love a little extra cash flow every month? So this video by Joshua Mayo breaks down his top 6 picks for these monthly dividend ETFs. He starts with his number 6 choice.
Okay, let's hear it.
It's DHS.
DHS.
Yep, the Wisdom Tree U.S. High Dividend Fund.
So focusing on those big dividend payers in the U.S. stock market.
Right on. Think familiar names like Pfizer, Cisco, Verizon, AT&T, Coca-Cola, those solid companies.
Makes sense. It's like getting a slice of those reliable dividend generators.
Exactly. Instant diversification with some big players. So tell me, what kind of returns has this ETF delivered over the past 10 years?
Let's see. Over the past decade, DHS has averaged about 11.57% annual return.
Wow, that's not bad at all.
No, it's not. Think about it. If you had invested $10,000 10 years ago, you'd be looking at almost $30,000 today.
Plus all those dividends along the way. Okay, starting to see why this one made the list. Now, what about the monthly payout? What's the current dividend yield for DHS?
Right now, it's sitting at about 3.77%.
Okay, 3.77%. Not too shabby. But before we get too excited, let's talk about those costs and risks. What's the expense ratio and what's the risk level according to the video?
Sure. So DHS has an expense ratio of 0.38%. That means for every $10,000 you've invested, you'd be paying about $38 a year in fees. And the video creator rates the risk at 3 out of 5.
Got it. So moderate risk for a decent yield. Makes sense. All right. Moving on to number 5 on the list, it's SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF.
The name says it all, doesn't it?
It really does. This one seems to be for those investors who want a bit more stability in their lives.
You got it. SPHD is all about providing income, but with less volatility. It targets the 50 least volatile, high dividend yielding stocks in the S&P 500.
So it's like a VIP club of steady performers. I like that.
Yeah.
How has this ETF been doing since it launched?
Well, SPHD hasn't been around for a full 10 years yet. It launched in 2012. But since then, it has produced an average annual return of about 11.03%.
So if you'd invested $10,000 back then, you'd be sitting on a little over $23,000 today. Pretty impressive. What about the dividend yield?
SPHD currently offers a dividend yield of 3.86%.
Slightly higher than DHS. Okay, what about the expense ratio and the risk level for this one?
For SPHD, you're looking at a very reasonable 0.30% expense ratio.
So just $30 per year in fees on a $10,000 investment. Not bad at all. And the risk?
Similar to DHS, it's rated a 3 out of 5.
Okay, so SPHD is looking pretty similar to DHS in terms of risk and fees, but with a slightly higher yield. Interesting. All right, let's move on to number 4 on the list. PGX, the Invesco Preferred ETF. This one seems a bit more specialized.
It is. PGX taps into the world of preferred shares.
Preferred shares. Can you remind us about those?
Sure. They're kind of like a hybrid between common stock and bonds.
Ah, I remember now. So they typically offer higher dividend yields than common stock, but with potentially less growth.
Exactly. It's all about finding that balance.
Makes sense. So how does PGX tap into this preferred share market? What's its strategy?
PGX tracked an index that represents the U.S. preferred securities market. It holds over 300 different preferred share issues, including big names like Citigroup, JPMorgan Chase, and Wells Fargo.
Wow, that's a lot of diversification. Okay, let's talk performance. How has PGX been doing over the past 10 years?
Over the past decade, PGX has returned about 6.73% annually.
So if I'd invested $10,000 back then, it'd be worth close to $19,000 today.
That's right. And right now, its dividend yield is sitting at 4.87%.
That's the highest yield we've seen so far. All right, what about the expense ratio and the risk level for PGX? Anything to worry about there?
Well, the expense ratio is a bit higher than the previous two. It's at 0.52%.
Okay, so that's $52 per year on a $10,000 investment, and the risk.
It's rated a 3 out of 5, same as the others.
So PGX offers a tempting yield, but with slightly higher fees. It's interesting to see how these different ETFs have their own strengths and weaknesses. Okay, what's next on the list? What's number 3?
Number 3 is DIV, the Global X Super Dividend US ETF.
Super dividend, huh? Sounds promising. What's the strategy behind this one?
This ETF specifically targets those high dividend paying U.S. stocks.
Sounds a bit like SPHD. How is it different?
You're right, they both focus on high dividend payers, but while SPHD sticks to the S&P 500, DIV considers the entire U.S. stock market to find the 50 highest yielding companies.
Ah, so it's casting a wider net.
Exactly. which means it might uncover opportunities that SPHD misses.
Okay, I can see the appeal there. So tell me, what kind of returns has DIV delivered since it launched?
Well, DIV has been around since 2013. Since then, it's generated an average annual return of about 4.67%.
That does seem a bit lower compared to some of the others, but I guess we have to remember its main focus is those dividends.
Right. The lower return could be a trade-off for higher dividend payouts. Speaking of which, DIV currently boasts a 5.80% dividend yield.
Wow, 5.80%. That is the highest we've seen so far. All right, before we get carried away, let's talk about those expenses and risks. What's the expense ratio, and what about the risk level for DIV?
DIV's expense ratio is 0.45%.
So $45 per year on a $10,000 investment. Okay, and what about the risk?
This is where it gets interesting. The risk level for DIV is rated a 5 out of 5.
Whoa, a 5 out of 5. That's the highest we've seen. Why such a high risk rating?
The video creator attributes that to DIV's concentrated portfolio. It only holds 50 companies, which can make it more vulnerable to market swings.
Okay, so high yield, but with higher risk attached. Definitely something to consider. All right, we're halfway through the list, ready to keep going.
That's it.
All right, number 2 on the list is SDIV, the Global X Super Dividend ETF. Wait, didn't we just cover DIV? Is this a repeat?
It's easy to get them confused. They both have super dividend in their names. But SDIV is different. Remember how DIV focused on U.S. companies? Well, SDIV goes global.
Ah, so this one is for those investors who want to diversify internationally.
Exactly. SDIV seeks out the 100 highest yielding stocks from all around the world.
Wow, that's taking diversification to a whole new level.
Yeah.
But I imagine that global reach also comes with some added risks, right?
Definitely. Investing internationally often means dealing with currency fluctuations and potentially greater economic and political uncertainties.
Makes sense. So what are some of the companies in this global mix? Any familiar names?
Some of its top holdings include China Power International and Yanzhou Coal, which U.S. investors might not be familiar with, but it really highlights SDIV's global reach.
That's fascinating. So tell me, how has SDIV performed over the last decade?
SDIV has returned about 3.01% per year on average over the past 10 years.
Okay, so slower growth compared to some of the others. But again, it's all about that dividend yield. What's SDIV offering?
SDIV boasts a 6.83% dividend yield.
Wow, that is impressive. It seems like taking on that added global risk might be paying off in terms of yield. Okay, let's round out the picture here. What about the expense ratio and the risk rating for SDIV?
SDIV's expense ratio is on the higher end at 0.59%.
So $59 per year for every $10,000 invested. Not cheap.
And as you might expect, given its global focus, it carries a 5 out of 5 risk rating.
All right, so high yield, high risk, and higher expenses. Definitely something to think about. Okay, drum roll, please. We finally reached the top spot. What's the #1 monthly dividend ETF, according to the video?
The winner is KBWD, the Invesco KBW High Dividend Yield Financial ETF.
Invesco KBW High Dividend Yield Financial ETF. That's a mouthful. So it's focusing specifically on financial companies.
That's right. It tracks an index of U.S. financial companies with high dividend yields.
Interesting. What kinds of companies are we talking about here?
These are typically companies involved in banking, insurance, providing financial products or services.
Okay, so a very targeted approach. What are some of KBWD's top holdings?
Most of them are probably not household names for the average investor. They tend to be smaller, more specialized financial companies.
Gotcha. So how has KBWD performed in terms of overall returns over the past decade?
KBWD has generated an average annual return of about 8.75% over the past 10 years.
Okay, not bad. But we're all here for that dividend yield, right? What's the big reveal?
Drum roll, please. KBWD is currently boasting a 7.37% dividend yield.
Wow. That's the highest we've seen yet. It seems like specializing in those financial companies is paying off in terms of yield. But there's always a but, right? What are the downsides? What are the trade-offs with this one?
Well, high yields often come with trade-offs, and in this case, it's the expense ratio. KBWD has a 1.24% expense ratio.
Ouch. That's more than double the cost of some of the other ETFs we've looked at. So for every $10,000 invested, you're looking at $124 per year, just in expenses.
Yep, that's a significant chunk of change.
It is. And what about the risk? I'm guessing it's also a 5 out of 5.
You guessed right. KBWD does carry a 5 out of 5 risk rating.
Okay, so it's the high risk, high reward option on this list. Highest dividend yield, but also the highest expense ratio and the highest risk. It really highlights the importance of considering all those factors, not just chasing the highest yield.
Absolutely. Each ETF has its own personality and risk profile.
Great point. Well, we've covered all 6 ETFs now, and wow, there's a lot to think about.
There is. It's fascinating to see how each one takes a different approach and comes with its own set of potential benefits and drawbacks.
Absolutely. One thing I'm still trying to wrap my head around is how that dividend yield percentage translates into actual dollars in my pocket. Can you break that down to me?
Sure. The video creator provides a simple formula to calculate the dividend per share.
Okay, lay it on me.
It's dividend yield divided by 100 multiplied by the share price.
Okay, that seems manageable. Can you walk me through an example using one of the ETFs we discussed?
Let's use KBWD, since it has the highest dividend yield.
Perfect. So KBWD has a 7.37% dividend yield, and at the time of the video, its share price was $20.41.
Right, so plugging those numbers into the formula, it would be 7.37 divided by 100 multiplied by $20.41.
Okay, so what does that give us?
That comes out to about $1.50 in dividends per year, per share of KBWD.
$1.50 per share. So how does that translate into a meaningful amount of income?
Well, the key is to own many shares. Let's say you had 1,000 shares of KBWD.
All right, so 1,000 shares multiplied by $1.50 per share, that's $1,500 per year in dividends. Not bad. And if we break that down monthly, it's about $125 per month.
Exactly. It starts to add up, especially if you reinvest those dividends and buy even more shares.
That's the beauty of compounding. Those dividends can really snowball over time. Okay, so we're starting to get a better grasp of how these dividend yields translate into real money. Now, I'm curious, what would you say are the most important things to remember about these ETFs?
Well, first of all, monthly dividend ETFs can be a great way to generate that consistent stream of passive income.
Passive income, who doesn't love that? And it seems like there's a wide variety of ETFs to choose from, each with its own unique strategy and risk profile.
Exactly. There's no one-size-fits-all approach. What works for one investor might not work for another. It's all about finding the right fit for your individual needs and goals.
And of course, understanding dividend yields and how to calculate those potential payouts is crucial for making informed investment decisions.
Absolutely. Knowledge is power when it comes to navigating the world of investing.
Well said. So, as we move on to the next part of this deep dive, I want to leave our listeners with this question. Given all these trade-offs, which of these ETFs or others you might find might be worth further research for you and your specific financial goals? Think about your own risk tolerance, your time horizon, and what you're hoping to achieve with your investments.
Great question, and something to keep in mind as we move forward and continue this exploration of monthly dividend ETFs and the whole concept of living off dividends.
Sounds good.
So living off dividends, it's an idea that captures a lot of people's imaginations.
It does. Imagine like just having this stream of passive income coming in every month.
That's the dream, right?
Right.
But how does it actually work? What are the nuts and bolts of living off dividends?
Yeah, that's what I'm curious about. Is it really possible?
It is, but it takes planning, and of course, it depends on several factors.
Like what?
Well, the dividend yield of your investments, the share price, and how much money you have invested overall.
Okay, so it's kind of a numbers game. The more shares you own, the more dividend income you'll receive. But how do you even figure out how many shares you'd need to reach your income goals? Where do you even start?
Well, the first step is figuring out your target monthly income. How much money do you need each month to cover your living expenses? That's your starting point.
All right, so knowing your monthly expenses, got it. Then what?
Then you need to consider the average dividend yield you expect to earn from your investments.
Right, and those yields can vary quite a bit. Remember those 6 ETFs we discussed? They range from like 3.77% all the way up to 7.37%.
Exactly. So for this example, let's assume a conservative average dividend yield of 4%.
4%. Okay, I'm back.
And let's say your target monthly income is $4,000.
$4,000 a month.
So to earn $4,000 per month from a 4% yield, you'd need to have, wait for it, $1,200,000 invested.
Whoa. $1,200,000? It's a lot of money. Not exactly pocket change.
It's not. But remember, this is just a hypothetical example. Your actual numbers will depend on your individual situation and your investment choices.
Right, of course. But it definitely highlights the fact that living off dividends requires a significant amount of capital. It's not a quick fix or a get-rich-quick scheme.
Exactly. It's a long-term strategy. It takes time, patience, and discipline.
Okay, so we've talked about the numbers, but what about the practical side of things? How do you actually build a portfolio that's geared towards generating enough dividend income to live on? What are some of the strategies people use?
One popular approach is called dividend growth investing.
Dividend growth investing. Tell me more.
It's not just about chasing the highest dividend yields right now. It's about finding companies that have a track record of consistently increasing their dividends over time.
Ah, so it's about sustainability and growth. You're looking for companies that are committed to sharing their profits with shareholders and are likely to continue doing so.
Exactly. And the beauty of this approach is that even if a company's dividend yield starts out relatively low, those consistent increases can really compound your returns over time.
Compounding, that's the key. It's like a snowball effect. Your earnings generate even more earnings.
Right. And when it comes to dividends, those compounding returns can really add up, especially if you're reinvesting those dividends to buy even more shares.
Okay, so dividend growth investing makes a lot of sense. But how do you actually find those companies that are consistently increasing their dividends? What are the signs to look for?
Well, it takes some research and analysis. You'd want to dig into a company's financial statements, look at their earnings growth over time, assess their payout ratio.
Your payout ratio, what's that?
It's the percentage of earnings that they distribute as dividends.
Got it. So it's not just about glancing at the current dividend yield, it's about looking under the hood and evaluating the company's financial health and their commitment to sharing those profits.
You got it.
Makes sense.
Yeah.
But are there any potential downsides to dividend growth investing? It can't all be sunshine and roses, right?
Well, like with any investment strategy, there are risks. Even companies with a solid history of dividend growth can face unexpected challenges. Things happen.
Right. The business world is unpredictable. So diversification is important, right? Spreading your risk across multiple companies.
Absolutely. Don't put all your eggs in one basket. And when it comes to dividend growth investing, it's also wise to consider companies in different stages of their dividend growth journey.
Different stages. What do you mean by that?
Well, some companies might be relatively early in their dividend growth phase, offering a lower current yield, but with the potential for rapid increases down the road.
Ah, so those are like the up-and-coming stars, the ones with high growth potential. What about companies in the later stages?
Those might have a higher current yield, but maybe a slower rate of dividend growth going forward. They're like the seasoned veterans, the steady earners.
So striking a balance between those two, the high growth companies and the steady veterans, could be a smart way to diversify your dividend portfolio. Okay, that makes sense. We've been talking about dividend growth investing, which focuses on individual companies. But what about those dividend ETFs we discussed earlier? Could they also play a role in building a portfolio for living off dividends?
Definitely. Dividend ETFs can be a fantastic choice, especially for those who want a more hands-off approach. They offer diversification and convenience all in one package.
Right, because instead of researching individual companies, you're basically buying a basket of stocks through a single ETF.
Exactly. And there are tons of dividend ETFs out there, so you can really tailor your approach based on your goals and your risk tolerance.
That sounds a lot easier than trying to pick individual stocks. But with so many ETFs to choose from, it can also be a bit overwhelming. Where do you even begin? How do you choose the right ones for your portfolio?
It all starts with self-awareness. You need to understand your investment goals, your risk tolerance, your time horizon. What are you hoping to achieve? How much risk are you comfortable taking? How long are you planning to invest?
Okay, so knowing yourself is the first step. And once you have that figured out, what are the key factors to consider when evaluating specific dividend ETFs? What should you be paying attention to?
Well, first, take a look at the ETF's underlying index or its investment strategy. What kinds of companies does it hold? What are its criteria for selecting and weighting those companies?
So you need to understand the rules the ETF follows when choosing its investments.
Right. Then look at the ETF's dividend yield and its history of dividend payments. Has it consistently paid dividends over time? Has it increased or decreased its distributions?
It's like checking the ETF's dividend track record.
Exactly. And don't forget about those expense ratios. Remember, ETFs do charge fees, and those can eat into your returns.
Right, always keep an eye on the costs. So lower expenses are generally better. What else is there to consider?
You might also want to look at the ETF's trading volume and its liquidity. Higher trading volume generally means it's easier to buy and sell shares without impacting the price too much.
Okay, so liquidity is important. Anything else?
And finally, consider the ETF's overall performance track record. How has it performed compared to its benchmark or to similar ETFs?
So it's like looking at the ETF's past performance to get an idea of how it might perform in the future.
Exactly. But remember, past performance is not a guarantee of future results. It's just one piece of the puzzle.
Right, of course. So choosing the right dividend ETFs involves doing your homework and carefully considering all these factors.
It does. But the good news is there are a ton of resources available to help you research and compare different ETFs, websites, articles, financial advisors. They can all provide valuable guidance.
That's a relief. It sounds like we've only just scratched the surface of this whole living off dividends thing. It's a lot more complex than I initially thought.
It is. It's a journey, not a destination. And it requires ongoing learning and adaptation.
Well said. You know, something that often comes up when people talk about dividend investing is the psychological aspect. It's not just about the numbers, right?
Absolutely. Investing is as much about psychology as it is about finance. And dividend investing can have some powerful psychological benefits that go beyond just the financial returns.
I'm curious to hear more about that. What are some of those psychological benefits? How can receiving those regular dividend payments affect our mindset and our overall well-being?
Well, for one thing, dividends provide a sense of tangible progress. It's like a concrete reward for your patience and your discipline as an investor.
It's like a little pat on the back from your investments.
Exactly. And those regular payments create a sense of financial security and stability.
It's like having a steady stream of income coming in no matter what the stock market is doing. Kind of like a safety net.
You got it. And because dividends are often associated with well-established, profitable companies, they can also boost your confidence in your investments.
It's like, you know, you're partnering with companies that are not only making money, but also sharing those profits with you. It creates a feeling of trust and shared success.
Precisely. And beyond those positive feelings, dividends can actually encourage long-term thinking and help you avoid making impulsive decisions.
Really? How so?
Well, when you're focused on receiving those regular dividend payments, it can shift your mindset away from the daily ups and downs of the market and towards the long-term growth potential of your investments.
It's like taking a step back and seeing the forest for the trees. You're less likely to panic and sell when the market dips because you know those dividends are still coming in.
Exactly. And by reducing those knee-jerk reactions, you're more likely to stick with your investment plan and ride out those inevitable market fluctuations.
So the psychological benefits of dividend investing are just as important as the financial benefits.
I would say so. It's a good reminder that investing is not just about numbers. It's about emotions, mindset, and your overall well-being.
Absolutely. Well, we've covered a lot of ground today, from specific ETFs to the concept of living off dividends, and even the psychology involved.
Yeah.
But I feel like there's still so much more to explore, so much more to uncover.
There is. And one thing that often comes up when discussing dividend investing is the sheer volume of information and opinions out there.
Oh, yeah, it's like a jungle of information. Blogs, podcasts, YouTube channels, financial advisors. Everyone seems to have an opinion on the best way to approach dividend investing.
It can be overwhelming, especially if you're just starting out.
It can. So how do you navigate all those different viewpoints and figure out what makes sense for you? How do you sift through all that noise?
It's a good question, and it requires a bit of critical thinking. Not all advice is created equal.
Right. You can't just believe everything you read or hear.
Some advice might be based on solid research and analysis, while others might be driven by personal biases or even ulterior motives.
So we need to be careful. What are some red flags to look out for when evaluating dividend investing advice?
Well, first, be wary of anyone promising guaranteed returns or making claims that sound too good to be true. Remember, investing always involves risk. There's no such thing as a sure thing.
If it sounds too good to be true, it probably is. What else should we be watching out for?
Pay attention to the source's credentials and experience. Are they a qualified financial advisor? Do they have a proven track record of success in dividend investing?
It's like checking their investment resume.
Exactly. And consider their potential biases. Are they affiliated with a particular brokerage firm or a specific investment product? Are they trying to sell you something?
So transparency is key. You want to make sure the advice you're getting is objective and unbiased.
Right. Be a critical thinker. Do your own research. Don't just take someone's word for it, even if they seem like an expert.
Okay, solid advice. So are there any resources you'd recommend to people who are looking to learn more about dividend investing?
There are tons of great resources out there. For a good foundation, I'd recommend The Single Best Investment by Lowell Miller and The Dividend Growth Investor by Jason Fiber.
Okay, those are good starting points. What about resources for keeping up with market trends and finding specific investment opportunities?
For that, I'd suggest reputable financial websites and publications like Seeking Alpha, Morningstar, The Motley Fool. They offer a mix of news, analysis, and often have a focus on dividend-paying companies.
Those are some of my go-to resources as well. And of course, since we're podcasts, I have to ask, are there any other dividend-focused podcasts that you recommend?
Well, obviously, I think The Deep Dive does a pretty good job, but there are others out there too. The Dividend Guy blog podcast with Mike Carew and Dividend Talk with European Dividend Growth Investor are both really good.
I've heard good things about those. So many choices.
It's all about finding the ones that resonate with you.
Well, we've covered a lot today. It seems like we've talked about just about everything you could possibly want to know about dividend investing.
Well, almost everything. There's one more thing we need to talk about. It's something that often gets overlooked, but it's really important.
Okay, I'm all ears. What is it?
Taxes.
Ah, yes! Taxes! Can't forget about those. But how do taxes affect dividend income?
Well, in most countries, dividends are considered taxable income, just like your regular salary.
Okay, that makes sense.
But the good news is that, in many cases, qualified dividends are taxed at a lower rate than your ordinary income.
Qualified dividends. What makes a dividend qualified?
There are specific rules and holding periods. For example, in the U.S., you generally need to hold a stock for a certain period of time before the dividends you receive on it are considered qualified.
Okay, so it's important to know the rules and make sure you're holding your investments long enough to benefit from that lower tax rate.
Exactly. And it's always a good idea to consult with a tax professional to make sure you're taking advantage of all the tax breaks and strategies that are available.
Great advice. So when you're crunching those numbers and calculating your potential dividend payouts, don't forget to factor in the taxes.
Exactly. It can make a big difference to your overall returns.
Well, I think we've truly covered it all today. We've gone deep into the world of dividend investing, from specific ETFs to the mechanics of yields, the strategies, the psychology, even the tax implications. It's been an amazing journey.
It has. And hopefully our listeners are feeling more informed and empowered to continue their own exploration of dividend investing.
I hope so too. And as we wrap up this episode, I want to leave our listeners with one final thought, something to ponder as they continue on their dividend investing journey.
Go ahead.
When we talk about building wealth through dividend investing, we often focus so much on the financial aspect. But what about the emotional side? How can we make sure that our quest for financial independence doesn't come at the expense of our overall happiness and fulfillment?
That's a really profound question. It's so easy to get caught up in the pursuit of wealth and lose sight of what truly matters. Remember, money is just a tool. It's not the end goal. It's a means to an end.
I love that. Money is a tool. So how can we use this tool of dividend investing to create a life that is not only financially secure, but also meaningful and joyful?
I think it starts with aligning your investment goals with your values and your overall life goals. What is it that you truly care about? What kind of life do you want to build for yourself, for those you love?
It's about looking beyond the financial returns and thinking about the bigger picture. How can your investments support the life you want to live?
Exactly. And remember, financial well-being is just one piece of the puzzle. There are so many other factors that contribute to a fulfilling life. Relationships, health, purpose, personal growth. Don't forget about those things.
It's about balance, making sure that your financial goals are in harmony with your overall life goals.
Well said. And remember, the journey of investing, just like the journey of life, is about more than just reaching a destination. It's about enjoying the ride and making choices that are aligned with what truly matters to you.
That's beautiful. I think that's a perfect note to end on. We've given our listeners a lot to think about today, and hopefully they feel inspired to continue exploring the world of dividend investing and how it can help them create a life they love.
I agree. Happy investing, everyone.
You know, it's really impressive how much information is out there about dividend investing.
It's a testament to its popularity these days.
Yeah, for sure. I mean, it makes sense, right? It's appealing to get those regular payouts from your investments. But I guess the downside is that it can be hard to know where to begin with so much info out there.
Yeah, you need a good foundation in the core principles.
Right, like those books you mentioned before, The Single Best Investment and The Dividend Growth Investor. I bet those can help people wrap their heads around the basics.
Absolutely, those are great starting points.
But then, how do you stay up to date on all the market trends and new opportunities? Everything's always changing.
For sure, it's a fast-moving world. Checking out those reputable financial websites and publications is key.
Right.
Seeking Alpha, Morningstar, The Motley Fool, stuff like that.
Yeah, those are great resources for sure. And since this is a podcast, gotta ask any other dividend-focused podcasts you like.
Of course, got to give a shout out to the Deep Dive.
Uh-huh, fair enough. But yeah, there are others too that are really good.
The Dividend Guy blog podcast with my crew is great. And then there's Dividend Talk with European Dividend Growth Investor.
Cool, yeah, I've heard of those. They each have their own spin on things, which I think is helpful.
Definitely. Got to find what works for you.
You know, as we're wrapping up this deep dive, I keep thinking about something we haven't really touched on.
With that.
It's like when we talk about building wealth through dividend investing, we get so focused on the money side of it. But what about the emotional side? Like, how do we make sure that chasing financial freedom doesn't make us unhappy? You know what I mean?
Oh, I hear you. It's easy to get caught up in just the numbers and forget what's really important. We got to remember, money's just a tool.
Totally. It's not the be-all, end-all.
Right. It's a means to an end, not the end itself.
So how do we use this tool of dividend investing to actually build a life that's not just financially secure, but also, like, fulfilling?
I think it starts with your values. You know, what do you truly care about? What kind of life do you want to have for yourself and your family and everyone?
Yeah, so it's not just about the money. It's about what that money lets you do and who you become.
Exactly. And don't forget, financial well-being is just one part of the picture. There's so much more to life. Relationships, health, having a purpose.
It's all about balance.
For sure. Finding that harmony between your financial goals and your life goals.
Well said. So to wrap up this whole deep dive, what's your final message to our listeners?
Just to keep learning, keep exploring, and most importantly, keep investing in yourself and in the life you want to build.
Couldn't have said it better myself. Thanks for joining me for this deep dive into the world of dividend investing. It's been a real pleasure exploring this topic with you. And until next time, happy investing, everyone.